Ladies and gentlemen, good day and welcome to the Q3FY25 conference call of Cello, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Karan Bhuwania from ICICI Securities. Thank you, and over to you, sir.
Thank you, Raik. Good morning, everyone. It's our pleasure at ISEC to host Q3FY25 results conference call of Cello World. From the management, we have Mr. Gaurav Rathod, Joint Managing Director, Mr. Atul Parolia, CFO. I'll now hand over the call to management for their opening remarks, post which we can open for the Q&A. Thank you. Over to you, sir.
Thank you, Karan. Good morning, everyone, and a very warm welcome to our company's earnings call. Joining me is our CFO, Mr. Atul Parolia, and our Investor Relations Advisor, SGA. The results and presentation are available on the stock exchange and on our website. I hope you had a chance to look at it. In the first half of the quarter, the festive demand was healthy. However, subsequently, there was some pressure on demand side due to lesser consumption and discretionary spending by the customers. For the quarter, revenue saw a growth and stood at rupees 557 crores as against rupees 527 crores for the same period last year. Despite a slow growth in revenue, we were able to maintain our EBITDA margin levels at 25% and 16% for PAT. Our operational efficiencies and stable input prices contributed to a general stability in our manufacturing costs. Our core business, consumer wear, grew by 8% for the quarter, year on year. The glassware facility began commercial production on February 1st and rolled out several new product lines, starting with our drinkware collection. We had achieved an efficiency level of around 50%, and we believe a gradual and continuous improvement happening in this area. Molded furniture grew by 7% year on year. The writing instrument business saw some recovery on the export side on a sequential basis. However, on a year-on-year basis, we are yet to scale back to previous year's level. But we are confident in this quarter to achieve good numbers given good export orders. Moving forward, we anticipate a rebound in consumption-driven demand supported by the Finance Minister's revised income tax policies in the budget and the recent interest rate cut. This is expected to boost the purchasing power of our largest customer segment, the middle class. To strengthen our position, we continue to have an innovative and a premiumized approach towards our product portfolio. Consistent spending towards brand building and a strategic expansion in our overall reach through various distribution models. I will now hand over to our CFO, Mr. Atul Parolia, for a financial highlight. Thank you very much.
Thank you, Gaurav, and good morning to everyone. I will be sharing the financial details for the quarter gone by. In Q3FY25, we achieved a revenue of INR 557 crore and EBITDA of rupee 140 crore with a healthy EBITDA margin of 25%. Our PAT stood at rupees 86 crore with a margin of 16%. Speaking of revenue mix, over 69% of revenue came from the consumer wear, 14% from the writing instruments, and remaining 17% from the molded furniture and allied products. Cello trade, our primary channel, contributed 79% of the sales, while export and online sales made up to around 88% and 9% respectively. Modern retail accounted for the remaining 4%. In terms of segment-wise margin, writing instrument led by 55% gross profit margin, followed by consumer where we achieved 50% and molded furniture at 44%. Speaking of 9-month FY25, revenue was rupees 1,548 crore and year-on-year growth of 4%. EBITDA stood at rupees 407 crore with a margin of 26%. PAT was rupees 251 crore with a margin of 16%. With this, I would like to open the session for question and answers.
Thank you, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi, sir. Can you tell us the date of commercial production for the glass plant?
Yeah, so the commercial production, which is saleable production, started on February 1st. That is the time we were able to, call it quality, which is saleable. Of course, we had started trial production before. So we were about 2.5 months. We were doing trial production, but which was not packable. But now we've got packable production since Feb 1st, and we have, just started selling.
Understood. And what kind of sales should we expect from this plant for this quarter, Jan to March quarter?
So Jan to March, you might not see a very big jump because we are just building a product line. So it is just initial, sales that is going to happen, but we are still waiting for building product lines. So we will be collecting some stock in the next couple of months, and you will see the real impact in the next quarter.
Fair enough. So April to June quarter, what kind of sales should we be building in? I just wanted to understand the kind of extent of ramp up. So in the first quarter, what kind of sales?
So we are anticipating about 5 to 7 crore additional revenue each month. So about in a quarter, about 20-25 crores in the first quarter. Of course, then it will scale up even further.
First quarter as in April to June?
April to June, correct.
Okay, so 25 crore in April to June, and then what?
Yeah.
And then what kind of scale up? Because I understand that the plant at full capacity can do a turnover of about 250 crore, right?
Correct, you're right.
So 25 crore is annualized 100 crore. So when do we reach that annualized 250 crore run rate? Is it 2 quarters, 3 quarters?
Correct. Currently, we are at only 50% efficiency levels. In the glass plant, it takes a little time because this is a 10-year furnace. So when we start, we achieve lower levels of efficiency. But as we build, so it takes about 6 odd months. So from now, 6 months, we will be at about 75-80%, which is when, the full capacity utilization kind of comes in or kicks in. So in the first year, we anticipate, close to 150 odd crore revenue from this plant, not the whole 250 crores. That is at peak capacity.
Got it. So second year should be 250, right?
Yes. That's what we would like to achieve, yes.
And another question is, since a lot of the costs here are fixed, at this 150 crore, would the margins be sort of affected negatively? How should we sort of build in?
I think we try and not. So of course we might not see very positive, PAT numbers, in the first odd year, which will basically start flowing in from the second year. But we hope to break even at least in the first year, or probably make a very small profit. So that's the idea going forward.
Got it. Or another way of thinking is at your Concall level, Concall EBITDA level, how many basis points of impact should I take from this plant in FY26? Would it be like 100 basis points impact at a Concall level, or how should I?
On a Concall level, yes. So EBITDA margins will still not be affected as much as your EBIT margins because all your costs are down. So your gross margins might be decently good for glass because they are actually pretty good in line with our other glassware products. But on EBIT levels, yes, it will affect more.
Okay, understood. So EBITDA, there is no dilution, which is like
EBITDA, there might be dilution by, as you said, about 1 basis point.
Understood.
But it will be temporary. It might actually, for the entire year, it might not even be that much.
Understood. Second question is on the writing instruments segment. So there is a decline here, but can you split it up between exports and domestic?
Sure. So exports is a major decline here. Domestic has been stagnant. So domestic also has not grown, but the decline has come due to exports. We had a lot of issues in the last quarter, which I had mentioned as well, that the exports There were a lot of shipping concerns. There was global slowdown. So the customers had kind of delayed orders as well. And because of the shipping concerns also, it got exaggerated a little bit. But we are seeing it back. We have seen some back, though we had expected a little more, comeback. But I think this quarter we are seeing good orders already in the pipeline. So at least if not growth, we might at least not have any degrowth for this year.
Got it. And for the domestic business, what would be required for it to show some good growth?
I think for the domestic business, consumer demand has been quite weak in this segment. If you see, barring one or two players, not much has happened. And even in the unlisted space, people are struggling a little bit. But I think overall consumer demand, as it improves, we should see some improvement. Also, we are adding product lines, as I mentioned.
Sir, participant has dropped. We will move to the next participant.
Sure.
The next question comes from the line of Praveen Sai from PL Capital. Please go ahead.
Right.
Yeah, thank you for taking my question. Sir, my first question is related to the gross margin, and especially in the consumer as well as in the writing instrument, the gross margin contraction is quite high in a quarter. So is that the RM inflation or some product mix change? Why, and will that continue at this level or improve?
So the gross margin level has contracted a little bit. Mainly it's because of, it's actually a factor of three factors, as you rightly said. It's part inflation of raw material, not a lot, but very limited inflation. Plus product mix has changed, mainly in the in the writing instrument segment, which is affected, and also in the consumer segment to a certain extent. And of course, there were some discounts that were passed on because due to weak demand conditions, there was some discounting that happened, which also has resulted in slightly lower gross margins. But I think as consumer demand improves, if you see, consumer wear actually grew at a decent pace of 8%. So I think we are kind of getting back a little bit of that demand. So as demand improves, this number should actually improve in the next few quarters.
Oh, okay. And especially in the writing part, if you look at your peers for the non-paper segment, their gross margin has not impacted actually. So that's why I was looking at your number. Why is it so? It's because of RM or some change in the distribution. What exactly versus the industry?
So two factors in writing instrument. One is, of course, basically the product mix has changed a little bit, and also due to export being lower than domestic sales. So export we slightly have better margins compared to domestic. So that is also one of the reasons why it has contracted a little bit.
Okay. Second questions are related to the, if you can give any color on the working capital side by end of 9 months, how it has moved.
Correct. Right. So I think we've kind of improved on the working capital side. Our trade receivables, which are about at 124 days in Q2 of 25, has now improved to about 111 days. Inventories have also improved by about 10 days, so from 98 days to 88 days. And of course, our trade payables stay pretty much the same as we pay in about 25 odd days. So we are seeing about a 20-day kind of drop in our working capital. We still, of course, there is a lot of room to improve here. Our target is about, to reach about 90 to 95 days in terms of our trade receivables. And inventories, I think we are at now optimal level. I don't see any improvement there, but I think trade receivables, we still want to go down to by about 15 days.
Okay. Second on the volume growth, if you can give in all three segments for 9 months or a quarter.
So volume growth is pretty much in line. I think it's not very different from the value growth of about 8% because there has not been a very 5% for the entire company. because raw material prices have been pretty stable. Volume growth slightly is more because your gross margins are contracted a little bit, but it's not too different. So normally we have a difference of about 3 to 4%. Value growth is slightly more than the volume, but this time around it is pretty much in line with value growth.
Okay. And can you give the capex number as well for 9 months and the full year and the next year expected?
The same number which we have expected last time, 275 crore, and the next year is around 75 to 100 crore.
Okay. Okay. And guidance is maintained 20% sales growth way forward, sir?
So I think way forward, it's not been a easy year for us this year around. So I think going forward, our guidance would be about, conservatively I'm saying, because, we've seen very weak demand in this past year. So if this continues, if it's slightly weaker still, we expect about 12 to 14% growth for the next year. Given that we also have an addition of revenue from our glassware plant. But if things improve, it can go up to about 15 to 17, which is where we would like to be, which we were in the past as well. So I think that would be something that we would be happy with.
Okay, great, sir. Thank you for taking my question. All the best.
Okay, thank you.
Thank you so much. The next question comes from the line of Achal Lohade from Nuvama Institutional Equities. Please go ahead.
Yeah, good morning, team. Thank you for the opportunity. Just a couple of questions. One is, can you highlight on the channel inventory, given you've talked about higher discount schemes, etc. Are you looking at the channel inventory already at optimal or slightly higher level, or is under stock?
No, you see, if we've improved in our days, debtors basically. So there has been actually a correction of a lot of inventory this year. So if you see the last quarter, the decent demand in the festive season kind of cleansed a lot of inventory, and I feel going forward, inventory position is pretty good. I think at our channel as well, in terms of our distributors and the retail counters. So I guess, that is not going to be a challenge in the coming year, at least, which was a big challenge this year.
So essentially you're saying channel inventory was a little higher in the start of the year and now it is at normal level. Have I understood right? Okay.
Yes, absolutely.
Second question is, if you could break this 12 to 14% growth in terms of these three segments.
Yeah. So I think in terms of the three segments, so about 3.5 to 4% additional revenue we will receive from, of course, the glassware plant. And if consumer wear grows even at about 8% and about and also the writing instrument segment at about 8 to 10%, which is conservative but should grow slightly faster, but at a conservative level about 8 to 10%, and furniture at about 5 to 7%. So because furniture this year has been a decent growth, normal, if you see the previous years, it's one of our toughest segment, and growth has been difficult. But this year has been a decent growth, which hopefully continues, but, we expect it to be about 5 to 7% around that number. So in total, this will total to about 12 to 14%.
Understood. Just remind me if, when we got listed, what was the revenue growth guidance and, given where we are currently talking, which 2 or 3 factors which have driven this correction?
So I think, when we got listed, the previous years, previous years before listing were about 30% growth. They were exceptional years. Of course, before that also we were growing at about 15 to 17% year on year. So I guess the last 1.5 to 2 years has been very difficult in terms of consumer demand. Actually has been pretty weak, and you see this across all the segments in the consumer, discretionary, and even FMCG. So I think improvement in that, we are seeing some improvement, and I think if that has been the biggest factor, driving this down a little bit. So I believe that once this is improving and with the budget, being favorable for the middle class, I think this number should change in this coming year.
Understood. There is nothing on any specific product, competition, or distribution, etc., which has got impacted this growth?
I think, if you look at our competition as well, their growth has also been pretty muted. Though there have been additional discounts doled out by, a lot of our competitors as well, but the growth in revenue has not been robust. So I guess, if you, in a bad demand scenario, it should, otherwise they should have taken a lot of market share, which has not happened. So I guess, keeping that in mind, I believe, overall, the macro scenario was so bad that probably, just keeping our margins intact and growing at maybe a slightly slower pace was probably the right approach that we took in the last couple of years. But going forward, I think we have a lot of, very good things happening in terms of, having additional kind of product lines that are being added. And I think this can now propel the company into a different kind of growth trajectory.
Understood. And just last question, Gaurav, with respect to margins, you commented about 12 to 14% revenue growth, but how do you see the margins panning out aggregate at company level, EBITDA margins, if you could guide for FY26 and 27 as well, if possible?
So EBITDA margins should be in line next year. Maybe as I mentioned earlier, that due to the glassware plant being just initiated and it takes a little time for efficiencies to come in, we might see slightly tapered, maybe 0.5 to 1 basis point. But EBIT margins might be hit a little more in the first couple of quarters. Maybe it will actually improve in the last. So we'll see how that goes. But overall, we would like to maintain it at about 10 to 12% in line with the value growth, but could be slightly 1.5% lower than the value growth that we'll expect. It's only for the next year. Of course, it will improve again because gross margins are pretty strong even in the glassware segment.
Got it. Thank you. I'll fall back in the queue. Thank you.
Thank you.
Thank you. A reminder to all participants, please press star and 1 to ask a question. The next question comes from the line of Ankur from HDFC Life. Please go ahead.
Yeah, hi, good morning. Thanks for your time. 2 questions. One, as we kind of enter the summer season and, the whole school reopening, etc., which is peak season for your lunch boxes, bottles. If you could just talk about, how is the channel restocking happening? Are you starting to see some signs of a rebound, on the demand side, or is it still fairly tepid like what you've seen over the last couple of quarters? So that's question number 1. Question number 2 would be, if you could also talk about impact, if any, of Q-commerce on your distribution channels, and how are you kind of handling the farm?
Right. So I think, of course, summer is a good season for us, and the bottles and the lunch bags, we're already seeing demand for it. It starts from about mid of February and goes up to about May and June. So restocking has been good in the channel, and that is why as I mentioned, our debtor days have also come down. That's because a lot of inventory has gotten corrected. So I guess this time around summer should be strong. Glassware again is a very summer heavy product. So the first quarter should be good, though we might not reach full efficiencies by then. But whatever product mix that we make, we'll hopefully see a pretty strong demand for that. I think sorry Ankur, your second question was
the impact of Q-commerce and how are you kind of dealing with that?
So quick commerce, so it's been a good start. We started last year. Of course, there is a lot of things that even they are figuring out in the kitchen and home space. But I think we are seeing decent growth. About in the tune of about 1.5 to 2% of our e-commerce sale today comes from that. But I think this number can be a lot larger in this year, as good as about 15-20%. So we are focusing on quick commerce, but there is a lot of corrections from their side that they are now implementing, because this was not a category of choice for them for so long. It was majorly groceries and other discretionaries. But now we see a lot of focus on this category. So this would drive, because e-commerce in India is still growing, in the, just about 8 to 10% in the normal channels, when I'm talking about, say, an Amazon or a Flipkart. But in quick commerce channels, we will, I think, see faster growth. So those will be propellers probably for this coming year.
Got it. Okay. And just to clarify on the EBITDA margins for next year, you said there may be a slight hit because of the start of this new glassware factory. But what kind of either absolute number range which you can provide on margins, EBITDA margins for next year? Where would you see that?
EBITDA margins about the maximum impact would be probably about a percentage point. That would be the impact.
Okay, over this year. Okay.
Yeah, over the years.
Okay, got it. Thank you.
Thank you.
Thank you so much. Participants, please press star and 1 to ask a question. The next question comes from the line of Sumant Kumar from Motilal Oswal Finance Service Limited. Please go ahead.
Hi, good morning. Can you talk about the export outlook? In last couple of quarters, we are seeing a subdued growth. So is it because of Russia or is it because of freight and container issue? What is the key issue there, and when we are going to rectify?
So I think the container issue has been a problem, and that is why a lot of shipments had gotten delayed. But it has improved. It's not that it has not improved in the last quarter, but now we see a bigger pipeline in the next quarter. So I believe that we'll be able to cover a lot of the loss of sale that has happened in the last quarter over this quarter. So we should end up, if not growth in the segment, at least at last year numbers.
Okay. And now coming to discounting, what percentage, what is the role of increasing in competitive intensity in consumer houseware, X of glass and opalware?
Right. So I think, you've seen that in the contraction of gross margins. Of course, it has been a mix of raw material product mix. But there has been some amount of about 0.5 to 0.7% of GP because of, basically discounting. So I think this has happened in this quarter. Of course, this is also a very heavy quarter, as you know, because of the festive season. So always, because the intensity was high this time, because everyone was facing challenges of selling. So there was part contraction, but I don't see this as a very long-term impact. This was a temporary impact that happened because of the weak demand scenario.
Thank you.
Thank you.
Thank you so much. Participants, please press star and 1 to ask a question. The next question comes from the line of Karan Bhatelia from Asian Market Securities. Please go ahead.
Hi, team. Good morning. So this is with respect to the opalware capacity expansion. Opalware capacity utilization. How does it stand now, and what are the targets for the next year?
Right. So opalware capacity for us is at about 80% today. We still have about 20% capacities left in this segment. And we hope to be at about 90 to 95% by next year, because we might see, our furnace will go under maintenance, so that we lose a little bit of our capacity. But otherwise, 90-95% capacity utilization by next year.
All right. And how is the pricing scenario now on the opalware side?
Pricing scenario is not bad, because we've had some, our raw material and energy costs had gone down over the years. So that, though the prices were slightly lower, but it was offset by lower input costs. So I think that is why the margin has not been affected too much.
Right. And like we've been focusing much on the new product launches. So how has been the new product launches count for the 9-month FY25?
So our overall product launches, if you see across all segments, it's about 15% contribution is of new products, which is actually in line with our every year kind of number. So even last year, this number stood at about 13 to 14%. So we are seeing similar number. 15 odd % comes from new product launches.
Right. And so in the previous calls, you've been mentioning to launch new products, especially in the writing instruments, crayons, geometry boxes, markers. So how is that ramp up happening?
It has happened to a certain extent, not a lot, but we are still working on it to build those product lines. And this should start contributing a lot more, from the next year.
Right. Thanks, Gaurav. That was helpful.
Thank you. Participants, you may press star and 1 to ask a question. The next question comes from the line of Praveen Sahai from PL Capital. Please go ahead.
Yeah, just a follow-up on the margin front. You indicated about the 1% impact. Is that you are talking about the only consumer segment or as a whole consolidated level because of a glass?
So the major impact will come from the consumer segment because of the glassware ramp up. So on an overall basis, it would be about 1% at the max. So just of course the impact is going to come from the consumer wear, but it will have an overall impact on the company EBITDA. So
just to understand this, 25% plus of margin you are delivering on. So on that you are saying the 1% of a contraction or in the EBITDA 1% reduction?
At max. Yes, at max. Yes.
So in place of a 25, 24% around you are expecting.
Yeah, around 24. Correct. That's right.
Thank you for the clarification.
Thank you.
Thank you. Participants, please press star and 1 to ask a question. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to the management for the closing comments.
Thank you so much. Hopefully we'll see much better quarters ahead. And thanks a lot, everyone.
Thank you, sir. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference. You may now disconnect your lines.